oversee a family office and holding company. We oversee a group of companies worldwide. We're called the Constructor Group. We have about 300 companies in our portfolio, between companies that principal has founded, invested in directly, and is an LP in various venture funds. We manage a number of businesses. We run and operate a university in Germany. We have a venture capital fund. We have several technology companies. My legal team is about 7 people worldwide, and then I am responsible for all external legal spend. I'm also the CEO and founder of a legal technology company that focuses on M&A, due diligence, and private equity work. I'm very, very interested in today's conversation because obviously a lot of the things that I do are very, very focused on alpha in the private markets. And I know that all of my esteemed colleagues here, they come at it from very, very different vantage points: public markets, private markets, hedge funds, et cetera. And so for me, this is actually as educational as it may be for all of you, just to kind of understand all of the different ways that we look at these opportunities in the market. So without further ado, I'm going to let each of you introduce yourselves. Just why don't you say a little bit about yourselves, what you do, and let's get started.
Hi, my name is
Yeah, turn it on. We can hear you.
My name is Simeon Basim. I'm the principal at Value Point Capital. And I've been in business for, I guess, about 20, 30 years. We do basically asymmetric risk reward investing. What does that mean? We look for turnaround situations where we have a very hard stop on the downside, and we have a very asymmetric reward on the upside. And this kind of investing requires a lot of timing, patience, understanding, and it's multi-category securities. A lot of it, of course, is in tech with the AI disruption, but it goes across the board. And happy to chat more about it.
Thank you.
It's Sheridan. I'm Andy Fish. I've been a fund manager for 41 years now. I'm 26. So I spent my first 20 years embedded in a multifamily office in Switzerland. No name on the door. Investors, captive capital. Ran hedge funds, traded commodities, then 3 venture capital funds. So then I made what would seem to be an odd switch. I built and ran State Street's global fund of hedge funds for 13 years. So people then actually began to know who I was. We invested all around the world. And then 9 years ago, I went back to family office, all privates. Haven't done anything in hedge funds again. And so there's alpha in a lot of places, and we'll get to that.
Hi, my name is IvyFON. I am the managing partner at Capital Management. I was trained as a computer scientist, but joined Wall Street, worked on the big banks for a few years, started my own tech private equity fund in 2013. Our expertise, I would say, is cross-border investment. We mainly invest in the tech space in US and China. Some, I would say well-known names we invested in are Alibaba, Uber, etc. For the last 1 year and a half, we've been focused on investing in the IPO market in Hong Kong. As some of you may have known that the Hong Kong market has been dormant for quite a few years, but this past year has been very active and hot, as we say. So I'd love to share some of my experiences over there.
Hi, I'm Rick Stone. I have my own family office, and I also run Palm Beach Investment Research Group, which is a not-for-profit group of 36 family offices that meet twice a month to vet various investment ideas, anything from hedge funds to private equity to venture capital, a lot of private lending, a lot of one-off biotech and tech deals. Each family makes their own investment decisions, but we share the due diligence process And that way we have people with expertise in various areas that can educate the rest of us. We've been in business 16 years. We've had over 1,000 managers come through.
Do we have
I'm
somebody
Tyson
else?
Halsey. Yes, I'm Tyson Halsey.
It's really-
Hello, everyone.
Hi,
Can you
Tyson.
see me?
We can see you.
Looking good. All right. So, I have a investment firm called Income Growth Advisors, and right now we're heavily in gold mining stocks. But I worked at Merrill Lynch, Alex Brown, set up my first hedge fund in '94 after winning the USA Today CNBC National Investment Challenge in '92, up 1,078% in one quarter, trading biotech stocks around, pivotal events. And I got into tech, got out at the top, but then got killed uh, in the aftermath. And that's what really taught me about cycles and understanding market cycles and reading Robert Shiller, becoming a disciple and believing that psychology and valuation are really critical to good long-term investment decision making. I set up a startup company focused in the energy space and worked with a couple experienced oil guys, but we never really found a project to launch, so that's kind of paused. But right now, we're actually looking at a unique deep value silver opportunity in Mexico with some people who already have a stake, and we're engaging an investment banker, and the opportunity is huge, and it's very early, and so we're always looking at things both in the public and the private space where we see big upside. And I've started writing more and more, and you can always check out what I'm doing or sign up Income Growth Advisors. But I tend to like to look at the big macro picture, and I think that we are in a pivotal period where we're switching from a deflationary environment to one where I think inflation is a dominant factor, and in particular, a weak dollar, and that is redefining where leadership will be over the next few years. Pass.
So Tyson, I just want to add to what you were saying. Cycles are very important. And I think when we get into a conversation about alpha, I mean, I was trading in the '87 crash, the dot-com bust running a venture fund, GFC running a global fund of hedge funds. Right now, my opinion is we are late cycle in all the privates, whether venture, private equity, whatever. So I think Tyson's talking about some very specific examples, but I think even if you have something specific, you're not in a vacuum. You have to look at what you're doing in the context of the world. I've been to Hong Kong 25 times, so over 20 years, so I've seen everything change there. So if you don't understand that, you could be running into something, even if that investment looks great.
So Andy, let's back up for a second, right? So I want to get into actually specific, and I want to talk about market trends and what you all see for 2026. But before we go into that, let's just start like very, very basic, because we don't know who's watching, who's here, right? Where everyone's coming from, what people are looking at. My first question for each of you, and I'm going to go down the list and then I'll pick you guys randomly. But my first question is really, how do you define alpha in your specific strategy? And how are you incorporating it?
So alpha can be defined in many ways. It's just not one way to cut the apple up. For us, the way we define it is purely risk reward basis. Like if you look at a security, what is the upside versus the downside? And it's a risk reward asymmetric, meaning that so let me backtrack a little bit. I think one of the questions that Marty asked in the email was about the diversification in the returns that we've seen in the market. And if you look at, for example, this market, we've had the S&P small cap down 4% for last year, and the S&P is up 14%. So did the S&P really produce, 14% alpha? Well, the way I look at it is the S&P was just moved by 10 stocks, and these 10 stocks produce 80% return since, ChatGPT was launched. So the market was really bifurcated in this move of two categories, which is basically is the security an AI winner or is an AI loser? And so the last year and a half, we had alpha generation, which was basically, is this an alpha AI winner? Meaning, is this company going to replace manpower, or is this company going to be a loser and it's going to lose manpower? And a lot of the alpha was just that particular pure trade. And I think now we're in the beginning stages of that trade reversing, where people are now questioning that just building infrastructure for the sake of building infrastructure is not really alpha generation. And AI is not really going to replace $4 trillion of money that's spent on manpower. So, market does move in extremes, and alpha does vary. So for the last year and a half, you guys said alpha just go long AI, go short, that's not AI. And now, the alpha is moving towards a different trade where, where people are questioning, do I really want to spend all that money and what's my ROI based on that? And so for us, we look at, okay, so if that ripple effect is going to go to the market, where is the alpha in these different sectors in a company where each of these sectors are going to gyrate widely, whether it's in the tech space, in the energy space, and how much of the downside, in this market, downside is more market psychology, like has the last bull bought and has the last bear sold. That's kind of the downside. You could put all the valuation metrics out there, but it's a very sentiment-driven, constant market. It's been tough because you just have 10 stocks that basically move the entire S&P for 500 stocks. So the long way to answer your question is alpha is basically looking at where the ripple effect in the market is shifting going forward.
Thank you. Andy.
So three kinds of alpha. He just described S&P 500, whatever. Simple alpha, you have an ETF, you have an active manager. Active manager beats ETF, positive alpha. Okay. In both cases, you're taking beta risk. So don't forget that part. Okay. That's not always the case when it comes in. So I'm going to leave that one out because I think all the assets are expensive. We're very opportunistic. We tend to stay out of the center, but still, as I said before, we follow everything that's going on. The other two types are interesting right now. One is relatively safe in the sense that it's not correlated to whether the market goes up or down. Those are strategies like arbitrage. We just talked about copper. You can trade the copper futures curve. You can be long 1 month and short another month. So copper goes up or down. It's the shape of the curve that matters. So if you have an active manager who knows how to do, I don't want to get too far into it, but backwardation and contango, shape of the curve. That's a way to generate alpha without betting on the metal. Another one is, which we are working on, is a CLO, collateralized loan obligation. On one side, you've got a portfolio of senior secured floating rate corporate loans. The other side, you sold senior secured floating rate notes. And what you're doing is, you, as the investor, you're capturing the difference in cash flow between what comes in and what you have to pay out. And everything's floating rate, very insensitive to interest rates. And then what happens is, as the it's called the equity investor, but forget that, it's not equity. You're capturing that excess cash flow. So if bonds go up or down, that those notes only move with interest rates. So a good manager will, you have structural alpha in the CLO, a good manager can add to that. So the third part, I would say, is the other type, which goes back to what Katya was talking about, is if you're a venture investor, private equity investor, and I'm not going to say venture funds or private equity funds. I think they're all in trouble. But that doesn't mean the companies, the opportunities aren't there. So, but doing that, for instance, buying something of value, I don't use the word cheap because sometimes cheap things are cheap for a reason. Frequently, you have to have expertise and management to unlock that value, whether it's electric capital, whether it's rechanging the management or whatever has to be done. Something has to be done to unlock the value in most cases. But if you just sit on it, that's not alpha. So that'd be my three sort of categories of alpha.
I think of alpha pretty simple. I felt like we just need to beat the S&P benchmark.
That was number one.
Yeah, exactly. It's been quite challenging recently to do that, even because S&P been performing well, and now even more challenging is gold itself has gone up a lot. So people sometimes even compare S&P with gold and say, is gold benched S&P? What's the absolute return? So it's definitely be interesting generate alpha for the last year. That's why we looked, across US and China, and then we found this very interesting spot of Hong Kong IPO market. And to be honest, the US IPO market has been absolutely amazing as well this year. Both market has generated, I read recently, like on average 35% for the first day pop. So that is really, really impressive. And we just realize that, IPO is amazing. Everybody wants to get in when it's in a good market. But how? Because every single family office that we know, every institution, every individual who has spare money wants to go into IPO because back to what you're saying, it's about risk adjusted reward. IPO is almost sometimes feel like a gift from the company. In one day you make 35%, certain times you make 50%, and 200% in one day. Yeah, it's in cycle, and we're in a good cycle this year. So the advantage we have is because of the last 1 decade, we've been in the tech space very deeply in the US and China. We have built this amazing relationship with some of the founders. And, as you probably know or may not, China and Hong Kong has been dormant for the last 5 years. And so finally the Chinese government, that's a completely different story, realized the World Cup saying that they need to really revitalize Hong Kong as a financial capital of the world. And so they completely loosen up the regulation and all this huge amount of pent-up demand from the founders and the companies were like, oh, now we have an exit. So they're going out and all these investors are coming in. And because we have amazing relationships with these founders, who have suffered, and we have suffered with them the last 5 years, we were given some of the really good treatment from these founders and corporates. We were able to get, meaningful allocations for our investors to participate in this bull run of the IPO market. We can go into more detail, and we do believe that this is a structural change in the Hong Kong market. We do believe that the Chinese government and regulators will still be very relaxed about this into 2026. So the opportunity is still there.
So alpha is risk-adjusted outperformance of the S&P or another index. That's all it is. Obviously, there are various areas where you can achieve alpha. This year, as pointed out, it's been hard to do that because we've been in a bull market in S&P and NASDAQ stock.
Tyson, do you have anything to add?
Yeah, I think of alpha as the outperformance relative to the S&P 500. And yes, beta can be a contributor to alpha. But I think that the way I look at it from a global perspective is there's just certain markets which start to outperform for one reason or another. And these days, I'm looking in particular at declining dollar beneficiaries, which include the metals, but the emerging markets and international, those are cheap. They have are now benefiting from a weaker dollar. And moving into those markets can make you a great deal of money. That's how John Templeton made a great deal of money. And I think that is part of alpha too. It's not just a statistic. It's understanding where the value is and where the money is flowing based on the underlying fundamentals of those particular markets.
Thank you. So Maggie, I'm gonna actually.
No, I was just gonna add to what Tyson said, and just 2 seconds of real world experience. So we were invested in 26 countries. And so we had, and across asset classes, so we had a big footprint in Asia, big footprint in Europe. And there was a point, not just Hong Kong, but a lot of Asia, where there was an inflection that it actually became expensive relative to Europe. I mean, it's all, as Tyson said, relative. So we're able to move a lot of risk investment because we have this big platform from one place to another. So that's sort of the parallel to cycles, is looking across globally where the wind is at your back or the wind is at your face, is the way I like to put it.
So Maggie, this is a question for you, and then anybody who wants to chime in can. So actually, Andy and I had a really nice Zoom yesterday and had the opportunity to get to know the rest of you prior to this call, but I got to know Andy. And he was talking to me about something really interesting, which he was talking about the secondary markets in private equity and venture, right? And so something that Andy was talking about is, we're in a world where assets are expensive right now. What do you do for value? There's this secondary market for private equity and VC, right? Just because you're getting a better price doesn't mean you need to have significant diligence, because since it's secondary, the diligence is already kind of taken care of, right? But then what kind of active process needs to be employed in order to unlock value? Is there any worry that you're inheriting someone else's problem, right? If we're taking a look at the fact that there are all these secondaries, there are family offices that are trying to offload some of their investments and the like, there's great opportunity there, but there's risk instead. So I'm just curious how you look at it, and then anyone else on the panel that wants to talk, please.
Sure. We are definitely not strangers to secondaries. We when we invested in Uber, for example, we put secondary LP interest from a fund, etc. So in the sense, yes, the first investor in would have done the due diligence, as you mentioned, but I think a big chunk of the due diligence you need to do is actually on the vehicle that you're investing in, or your counterpart. We have definitely, for example, looked into certain deals back then, like say Binance. Even today, people are still looking into offset, sell some of the Binance before going IPO. But then when you look at the seller, you're like, "Ooh, this profile is a bit, interesting." Sometimes you come across as, there's potential governmental links and stuff like that. So those are the added layers of due diligence you want to make sure to do before, I would say, tackle yourself into the secondary market. Happy to hear your thoughts.
Yeah. So on that point, there's another level of due diligence when you're buying a secondary, is you're not just inheriting the portfolio, you're inheriting the manager. So the question is that where does that manager stand today versus when that person made the original investment? So in 2009, 2010, we bought tons of secondaries. We were one of the few places we didn't lose money away. We had a lot of cash. But with that said, we only went in where we could do due diligence on the portfolio. And I'll give you one example of one that we went all in on. Convertible bonds were very out of favor, and a lot of firms were going down. We went into one firm, and the senior partner said, "We put up 2 years of working capital in the firm. If we have no investors in 2 years, we will still be sitting here doing our job." So it's an analogy. I'm just giving you, because you can go into a place where the portfolio looks great, but the general partner's on fire. And that's not something you can easily get.
Has anyone done a study on the secondaries market and all these continuation funds and actually figured out what the ultimate IRR was for something that was invested in? And maybe the secondary made a little bit of profitability, but the IRR of it from like 1 to 15 years is not great. Has anybody done?
Do you want to look at my inbox and then run an AI thing over? Because I
didn't ask, but I mean.
No, I have continuation funds come in one after the other. I think in each cycle, I think we're what I call late cycle. Things aren't collapsing, falling apart, whatever. So I don't think we can measure that quite yet. Let me give you one example. By the way, it's a Hong Kong fund. Okay, they sent me a continuation fund. They had done their first fund, 15 companies. The continuation fund was they had taken 5 companies. Okay, so my first thought was that you're the GP, and what about the investors who came in at the beginning? I'm coming in now on 5 companies out of 15. You know, what are you doing, you know, for them? And as a guy who ran a VC fund, a Combust, rights offerings being crushed down and something like that are common. Now, maybe it's a good thing and maybe it's not. I'm trying to say is it would take a whole bunch of work to figure out, and I'm not going to repeat myself, to go back and is it just the companies? What about the manager? And then I'd probably call her because she's in Hong Kong and they're down the street and everybody in Hong Kong knows each other and haven't been there in a while. So I don't think, Marty, I think there is value, but I think if you bought across the board, I think you're a loser.
I mean, I think the rhetorical question is that academia says there should be a 4% improvement over S&P 500 for long duration investments like private equity. But I don't think academia has spoken on what is the opportunity cost for another 5 years from expected, right? Because historically, private equity has been 7 to 10 year investments, and now it's going to be going on 13 to 15 years, which I don't think anybody really accounted.
So 2 quick comments really fast, because the data from private equity and venture capital has horrible survivorship bias. So when an academic takes a bunch of data, it's not like hedge funds. Like you could literally tell who had Madoff in a fund of fund, because the ones that had Madoff were all crushed down and the ones that didn't were fine. I mean, you can just see it, but the survivorship bias is horrible. So I don't trust the data. You also get
survivorship bias is on the positive side or negative side?
No, it overinflates it because the losers never show up.
It overstates it.
They're not reporting. They called stop reporting. So I was trying to keep it super short.
It exists in hedge funds, but not as
No, I'm talking about venture. I'm talking about venture and private equity, not hedge funds.
It's not it does, but
hedge funds is
Yeah.
different.
I did have a question for Maggie. I don't know if I'm getting ahead on Hong Kong. And I think has the movement to Hong Kong been because of political influence? I think that there was it Timu or one of those groups. They were coming to us with secondaries last year, right? We have a big group on WhatsApp, etc. And was saying that they were going to go public in Hong Kong. Mm-hmm. And did that happen?
But before she answers, I'm just saying my inbox is full of Silicon Valley. But go ahead about Hong Kong.
Okay.
That's why I'm asking her.
I am too.
Yeah, well, anything is moving near China is all political. So, I'm not sure about if the particular IPO you were referring to that was in your WhatsApp group that moved the needle, but the general idea is that, China was very tight on Hong Kong for a long time, like cracking and stuff and trying to move it closer to Singapore so a lot of the money escaped to Singapore, and a few years later the Communist Party caught up and saying, oh wow, we're losing this jewel of Asia, Hong Kong, to Singapore, basically hand over billions and billions of dollars there, and we want Hong Kong back. If you once scared the foreign money away, it's very hard to lure them back in a short period of time. So what the government figured out is saying that we still domestically has a lot of wealth, and there are institutional investors in Hong Kong that's still looking into investing into mainland China. The demand and the markets are there. So they said, why don't we open up the IPO market, which means a lot of the companies in China, interestingly enough, are now discouraged to be listed in mainland China, in Hong Kong, in Shanghai Exchange, which is the A share. They're discouraged. They are very much encouraged to be listed in Hong Kong, which is called the H share. And we also see a phenomenon which is called A+H listing, which is saying the company has already gone public in mainland China, and now they are open. The government and the regulators encourage them to do dual listing, which they're again going to Hong Kong listed. And now they have, Hong Kong dollars, which is more circulating around the world. And we see a lot of companies loving it. For example, one of the companies we advised is a top AI infrastructure builder supplier. It's one of the top 3 in the world. They're China-based, but they have moved the majority of their market to the US. They have built factories in Mexico here. And as of today, their revenue is 94% generated in US. They practically no longer is a Chinese company. They have like 1 factory left in China. They have been listed in Shanghai for a few years and been doing well. And they were like, now the government allows us to do H-share this thing. That's amazing because we want to stay away from mainland China. Now we want to focus in the Northern America market. So they did an IPO. We advised them, our investors got an amazing allocation. We got basically 10% of that allocation, which is a $700 million USD IPO, which is very substantial. And they did extremely well. The first day pop was like 35%. And now they're very happy because they have all these Hong Kong dollars, which is not regulated by the Chinese government. They can freely invest anywhere in the world. And they have a very big investor base that's international across Europe and Asia, and etc. So back to your question, to the initial question, it is definitely a structural change. It's regulatory based. Is China government supporting it? And we don't see that trend stop anytime soon.
Can I ask you a
I
question
think
on that?
Russell had a question.
Oh, sorry. Oh, I'm sorry.
I'll just speak loudly. No mic. So, I'm a family office. Years and years ago, I used to be on the other side working for Morgan Stanley with IPOs, etc. My question is not just for the IPOs in Hong Kong, but in general, one of the biggest challenges for anyone in the family office is really to get into those IPOs at the good price. We used to unfortunately give only the bad IPOs to the family offices and the good IPOs to the institutions.
Yeah.
And so it's a month's game. That hasn't changed. Sorry, that's my opinion. So what's your comment on that?
Is that the academic board, by the way?
Well, that's the practice.
That's just the fact.
That's absolutely the fact. It's the most honest assessment. That's why I was saying that we would not have gone into the IPO market if we don't have access to the founders and the top tier executive managements. Like you said, I recently spoke with the biggest insurer in China. Okay, they have an asset management arm in Hong Kong. They have so much money. And he told me, Maggie, you're not going to believe this. Okay, the smallest allocation I received this year was $50,000 US. We're talking about the biggest insurer of China, the asset manager arm in Hong Kong. He said it was the biggest insult to our team. He said, what am I supposed to do with the 50K? I'm a retail investor to you, like, it's better you give me 0 than give me 50K.
Just open a brokerage again.
Yeah. So it's, and we also, we participated in US IPOs in the past, we participate in Hong Kong IPOs. The key is really relationship with the top management of the company. Even the underwriters, in all honesty, don't have as much of a saying. Even the sole sponsors, because if you think about your family office, you're competing with a lot of like hedge funds or institutions. These sponsors have hundreds of clients who are on the book begging them for allocation, right? You have to be a top client of theirs to go into the room to fight for you. But oftentimes family office left out because, they're just not as big as some of the biggest like funds. So happy to talk with anybody interested in IPOs after the conversation or this panel, because, we try to help really legit and value-added investors to access the IPOs. We think it's win-win-win situation. It's win for the investor, it's win for the company, and of course it's win for us. And the real honesty is we don't have that many access either. For example, as of at the end of October, there were 67 IPOs in Hong Kong. We only had handful access to them. But you don't need all 67 IPOs, right? You just need 1 to 5 IPOs this year, and you make substantial returns, especially if they're top-notch companies. So I just leave it there.
Can I ask
Thank you so much.
That's a question, Asian, or are they American family offices, or who are your co-investor companies?
So my investors are like yours, it's around the world. We have European, Asia, and US. US investors as of January this year is facing additional challenges because there is one regulation called the Final Outbound Investment Rule issued by the Treasury Department. Basically, if you are a US-based investor and you want to invest in any Chinese companies that is in semiconductor, AI, or quant computing, then you have to notify the Treasury. They didn't say you can't invest. It just said you need to notify, which we don't even want to get into. I mean, who wants to notify
It's a technology
Treasury?
transfer.
So we have a question right over here from the audience.
But other than those three sectors, you can freely participate.
Can you repeat the question also so the audience? Like...
Yeah, absolutely. So go ahead, ask your question.
Absolutely. So by the way, great comment on quantum computing semiconductors, because that's exactly what we do. Question for you regarding IPOs, SPACs. So SPACs seems are making a comeback. One of our companies just went SPAC, or is going SPAC, 2.4 billion. Question for you on how you guys are viewing it, because it seemed before the web institutions were very allergic to doing it. Now they're actually active participants. JP Morgan, Citigroup, Morgan Stanley, all really going into the stock market. Where do you guys see it going?
So just to repeat the question for anybody who's listening at home, and I'm just going to paraphrase, SPACs were not cool for a few years. I know I was on the board of a SPAC. People kind of rolled their eyes when I told them about it. They became sexy again recently. Now you have JP Morgan, other big banks participating in SPACs. The question over here was sort of how you take a look at them and what your involvement is.
So yeah, I've loved the SPAC universe. SPACs are not new, by the way. SPACs have been around for decades. They used to be boring. There weren't many, and you put up your money, you got a small interest rate, and then you got to decide if you want to do the deal. And then somewhere something happened, I think it's calmed down, where remember, you're putting in $1. There's no deal. It's just sitting in cash, waiting for a deal to come along. It's paying you some small interest rate. Somehow the shares of those companies started trading above $1. I even saw one over $2. So this is a mania, because it's the definition of one. If you're going to pay $2 for $1 of cash, there's no deal yet. There's no company. Nothing's happened yet. So I think the people that were trying to take companies public through SPACs had a sort of field day for a little while, and I think that's calmed down. The ones that I've seen go across now are real companies. And the SPACs that are coming out, instead of being like, well, we could do anything, they're not. They're like SPACs looking for a healthcare deal, SPACs looking for a semiconductor deal, because you don't do healthcare. So no, what I'm saying is that it was a boring like sidecar, then it became a mania, and now I think it is reverted back to something a little more rational, a little more organized, and so all of these tools used properly, reverse mergers, other things, but they can be abused as well.
Marty, how much time do we have left? Just curious.
You've got about 15 minutes, but I wanted to raise a point.
All right, go ahead, please.
So, SPACs are very popular for the banking community. But I mean, the 2021 SPACs that all came out, like 700 of them. I think they were all at average prices like $3, $4. So they all like lost 60%. Even my buddy who had
I think I said that.
He did a SPAC. And it had a $2 billion valuation, and he just got sold to Charles Schwab for 600 million. But he made a couple $100 million from it.
That's the problem. He didn't do anything. He made a couple of them.
Yeah.
We have a gentleman in the back who has a question.
Yeah, I had something, first medical SPAC ever, it's a grand total of $10 million. But the real danger in SPACs are those which have warrants attached, and those create an enormous problem because fundamental investors don't go into them, trading investors do, and then opt to sell their stock and keep the warrants or vice versa, and that creates an enormous volatility in when they de-SPAC. So they're dangerous instruments if the warrants are very favorable to the investors.
So what this gentleman back here is saying is that, first of all, he participated in the first medical SPAC, right? And he's saying that SPACs can be fantastic, but there is a danger when you have warrants attached to them. right? So I think if any of you wanted to
So
go ahead and
The
comment
the
on that.
simple answer is, that was a long time ago. Every SPAC that I have seen has warrants attached to it, because that's the attraction to give money into a vehicle that has no investment.
Great.
So-
I think
So
we need to get
let's
Tyson.
move over, right?
That's it.
Because we have Tyson, we have Richard, we have Samir, we haven't had a chance to hear any of them
Just a
talk.
SPAC
This is all I know. It's exciting stuff, but there's so much here to talk about. So I'm gonna actually just move this back a little bit. So actually, let me go over to Richard and Tyson, and Samir, I'll have a question for you as well. But my first question for you, Richard, because of the fact that you've been doing this for some time, you run a group of family offices and the like. My question for you is, what's the one common mistake that investors make during cycle turns? Because I'm sure you've lived through many of these cycles, many of these hype cycles, booms and busts. What do you see? What are the patterns?
We don't make the mistake, which is thinking that
Can we get in the microphone?
Yeah.
the main mistake is thinking that the current trading environment will exist forever. And we don't make that mistake because we realize we're in a bubble now in AI that's created mega companies with a currency that's being used to inflate other stocks. And we see it all across the marketplace. So we're not looking to invest longer term in any private equity or venture capital now because we believe there'll be a bust before that gets paid. Our real lament is that in our 16 years, we still have deals that we did on day one that are out there that have 10 or 20% of their money unharvested because the manager is a true believer in two companies and wants to get management fees. So the entire structure of long dated investments is really in our mind a question. And we're moving much more into trading strategies. The best IPO market in the world is not Hong Kong, it's India, where you could have made 50% of your money flipping IPO a single day. And I did if you have a local. You can't do it abroad. And it's almost impossible for a US citizen to become a trader on the Indian market. The IPOs are small, they're $2, $3, $4, $5 billion. They're almost always sold first day. You have to post your money in advance and you get allocated. But once you get known, you get allocations. So we've done a lot of that. But we're looking for trading strategies rather than longer term deals because it's not possible that the market won't revert to the mean at some point in the near future. That may not be next year, it may not be the year after, but holding a 10 or 12 year or 15-year investment, as Marty points out, doesn't make sense when you know that the market's overvalued now. So we're hesitant to do that. And there's a lot of alpha strategies that are shorter term. While I do think private lending has too much money in the sector, there are specialty lending opportunities out there that, if you do diligence correctly, are fabulous. There's dozens of one-off litigation finance deals right now that are doubles in 3 or 4 years, but you have to have a real lawyer from a real law firm do the analysis. Fortunately, I was a partner in a big law firm. I do my own analysis, but we've had solid doubles in litigation finance in 3 and 4 years and quite a few others. And we also think there are other areas of specialty finance, movies, record labels, merchant finance. You can do a solid 15 to 20%.
Are you talking about like prints and advertising?
Not prints and advertising. We do movie credits, the tax credits. We don't finance the movies themselves.
Sure, yeah.
But once the movie's complete, the tax credit's paid, and you finance that for typically 1 to 2 years. The risk is the movie doesn't get done. It's happened once across our whole portfolio, and then record portfolios, songs, which have a very traditional pattern, and you can use an algorithm pretty much to determine what the cash flows will be. And merchant finance, which is, everybody thinks it's got a high default rate. It doesn't. Lending to restaurants, lending to local businesses, small amounts of money. It's been a 20% business for the last decade. Yes, if we get into a deep recession, you're in trouble, but the money's only out there for 60 days.
Somebody came to me for litigation finance strategy where you finance the lifestyle of the litigant while the litigation is going on. Is that a good strategy?
Well, you're factoring. You're loaning him money against. You're factoring. You're loaning him money again. You have to be certain. But a big part of litigation finance, variations of litigation finance. There's law firm finance, which is a great business because you have a lawyer behind the loan. And a lawyer can't declare bankruptcy and continue to practice because that's a really bad thing to do. You don't we have Homestead in Florida and you don't get personal guarantees, but there's the practicality of a lawyer declaring bankruptcy. It doesn't happen. So that's a really good business. Then there's one-off litigation finance. I don't take risk in a portfolio of litigation because I've been doing this for 30 years and you can't predict litigation. You don't know what an appellate court judge will do. We're full of Trump judges now who reverse district courts on a whim. I'm in there. So I only do cases where we won at the district court and I assess the appellate risk. Appellate risk is much easier to assess than district court risk.
So no portfolios, it's all.
No portfolios, all one-off.
Very interesting, Richard. I actually started off my career in the entertainment industry, so we worked with Eric Clapton and Michael Bolton and all of that. I was at Universal Music, it was like 20 years ago. So it's just very exciting for me to think that somebody still sees a lot of opportunity in the music industry, considering how much the technology has changed, which I actually want to get into technology talking with Samir. But before I do that, Tyson, I have the same question for you that I had for Richard. It was really just about market turns, mistakes that investors make, and mistakes that you don't make.
Richard said something I agree with, and one of the great risks in this business is recency bias. In other words, oh, we've been investing in large cap tech in the S&P, and we have this tremendous record. Been there, done that, made a whole lot of money in spaces, set up a hedge fund only to catch the top. You do that a couple times, you kind of learn. There's this whole crowd feedback loop mechanism where things just go to extremes. Everyone buys in at the top, and I feel like that's where we are today. And that's why, looking at other markets where there is real value and understanding what is driving those new markets is really critical, I think, in terms of identifying alpha. I think one of the major factors that is new, what is different today, is that we have a weak dollar, and that is changing the fundamental factors that now make international equity investing much more attractive. And I think that also impacts commodities. I think that the whole commodity sector could do well as a result of the inflation we've seen, but in particular, the monetary metals have been outperformers. And from a valuation standpoint, you look at the performance of the GDX, which is the gold ETF, it's up like 130% in 1 year. And frankly, it could double again. And the valuation on it is probably 12 times earnings. And the earnings are just blowing through the estimates, but they're being driven by a dollar, which in fact, because central banks are now adding gold to their treasuries, may go a lot higher than 6,500, which would be consistent with your typical cycle move in gold of about 510%.
Thank you. And so now, Samir, I want to jump over to you. So I kind of have two questions for you. You can choose how you want to answer them or mix them together. So one question I have for you is really what you're excited about and what you see in the markets going into 2026. And my other question for you is how technology itself has changed alpha. So there's the question of investing into technologies. Richard was talking earlier about sort of this AI bubble that we're in, which I'm sure you're quite familiar with. And then my other question is not just the opportunities for investment, but also how technology then governs how you look for alpha opportunities.
That's a great question. So just to continue a bit on the point about the recency bias, I think one of the mistakes that investors or family office or investors is that they think the future will be just like the past. Usually it is, but there are certain cycle points where things change. So what do I mean by that? So like I started the conversation earlier on saying that, in the last 2 years, 80% of the move in the S&P was just captured by 10 stocks, right? And what was the basic theme around the planet, which was, all right, let's throw a whole bunch of money in building data centers and something useful will come out of it. And it worked because, people just threw money and they built more data centers. And so, but it only works till it works. So for example, if you look at Microsoft, one of the biggest companies out there in the AI space, what's driven it, it's just adding AI capacity or selling AI capacity through Azure and its investments into OpenAI. And if you look at Microsoft now, and you said that, well, it's at 30 times earnings, and right at the bubble, it was at, in 2000, it was also at 30 times earnings. So it's, and the Fed is accommodative, so it should continue that way. And that logic is correct. The only difference is that 25 years ago, Microsoft was only spending 10% of their revenues on CapEx, and now it's 25% of the CapEx. So yes, you are buying the S&P, but you're buying 10 stocks, and you're not buying the same amount of free cash that these companies were generating at the height of the bubble 25 years ago. So the S&P's earnings are a lot less and lower quality now than they were before. That doesn't mean you can't continue that way. So what can change that? So finally, I'm of the belief that where is the opportunity next year? Like the opportunity in the last 2-3 years was basically these 10 companies, they rule the world, just own these 10 companies. Why do you want to do anything else? Because it doesn't work. And people believe it because it's working and they don't want to look at anything else. So which has created this whole AI winner, AI loser thing. Now, what I think the opportunity is in the democratization of AI. What does that mean? Companies that typically did not participate just on building AI CapEx the market's going to move from looking at them to companies that build the products and services and enhance their businesses.
Productivity.
Not just productivity, it's just more application. It's more like agentic AI specifics that we can get deeper into. That the market is now finally saying that, okay, I'm at least willing to consider the fact that this trade that's gone on for 2 years of AI winner and AI loser may reverse. And as that trade reverses, it just has to reverse a little bit, and you can see a wild gyration in a lot of these stocks that have been crushed because they're perceived as AI losers because they have labor, and they say, oh, the purpose of AI is to just take out human labor. The purpose of AI is not to take out human labor. The purpose of AI is to make human labor more productive. Like when the calculator came out, you did not fire the damn, accountant. You just made him more productive, right? So that's the point. We will create these new products and services, and humans will become more productive with them. And there are companies that are like screaming, like, maybe 2 years ago, it would have been so easy to make money on that. And now the psychology has become so entrenched that, big managers like Wellington and Tito and all of that puked out these companies, and they are saying, no, I just want to be in these 10 stocks. And now realizing, well, these 10 stocks are producing an ROI that's questionable, we had a big short trade on in the neo clouds, for example, the core beats, and the reasoning being that it's not that you have a short supply of NVIDIA. It's basically the market was, all these players were in a hoarding mode, like, okay, I need to build capacity and I need to make sure that you don't get capacity. So I'll just buy capacity. Meta's going to buy capacity so that Google doesn't get the capacity. That was like the mindset going on over there. And now, and they didn't really have, even the hyperscalers and big, they didn't really have the CapEx to do. So they created this cottage industry with Blue Owl, which you have off-balance sheet financing. And now that's all going to slowly come to roost. That doesn't mean the bubble's going to burst. It just means it's going to bifurcate. Why is the bubble not going to burst? Because I think we have a very accommodative Fed. They're going to lower rates, all that good stuff. As long as you've got monetary policy, we're just going to move ahead. But my basic point is that there are sectors that have been crushed so badly in this AI winner loser trade that are begging to move up double or triple from where they are. A lot of them, the first ones are the design companies, the engineering design companies are going to go and to these companies and take, all right, let's take this capacity, let's make you guys more productive, let's build you some agents and all that stuff. So these are human beings. So you always need the subject matter expert. So there's going to be a ton of money that's going to somehow pause in the AI CapEx, and people say, okay, let's just go and see what's the ROI on this CapEx. Let's just deploy.
Yeah.
And
I just
So
have.
I have a question. Marty had a question, and then I want to see if anyone else has any questions.
Yeah,
Because I think we're at the end.
just had a quick question, 'cause I think that people don't really consider external forces on this whole AI argument, which I talk about all the time in our WhatsApp group. But, you know, their issue is anybody considering Chinese AI as a substitution for all this expensive American AI? Because it seems like the Chinese models are pretty inexpensive. and
I'll
they're
answer
giving
that
it away.
tomorrow.
Yes, we're having that discussion tomorrow, but
I'll
just at
answer
a
it
very
tomorrow.
high level, you know, for 30 seconds or less.
So
Is that
I-
part of your trading formula?
so I came across a report which said American companies are now even using DeepSeek. Like, you don't really have to use ChatGPT. Chinese companies can provide the same level of quality with much less cost that the US can provide. So there's a misnomer that the US is that far ahead. US is not that far ahead. It's a little bit ahead. And with the amount of resources the Chinese government is putting into catching up with the US, well, maybe we have a 2-year head start. And
I totally doubt that. I think it's like Chinese AI is like the Sputnik moment. Nobody's just stated it yet. Anyway.
All right, we had a question over here. Let's see if we have any other questions. And then
I
we
have
have
a
another
question for
gentleman
Samir.
here. Okay, let's go.
So along with the question with and obviously everybody's been talking about the model, but not everyone, obviously we talked about data centers at some point, right? Where do you guys see the real investment opportunity in terms of infrastructure for all of this? Obviously data centers, power, some people are going into saying, what do these data centers consume, right? So, you know, as the proverbial phrase mothers like to use, you are what you eat, right? So if you put hardware GPUs inside these data centers, you're not going to get the exact results that you want. So the question is, where do you guys see the maximum?
Since Maggie's a tech investor, we're gonna let her talk about it.
Maggie, go for it, Maggie.
Go ahead.
Yeah.
Andy,
Go ahead.
the question.
Yeah, repeat the question.
Let me repeat the question. Sorry. No, I mean, I'll do like a very short version. So basically what he's asking about is with the data centers and saying with the GPUs that sort of you are what you eat, and how do you take a look at that and quality and understanding what you're building up.
So we're very involved in this. We work with some of the biggest developers for data centers around the world. The number one thing is power. Where can you get the cheapest power in the world? That's where you see the site. We see a lot of Asian developments now, particularly in Indonesia. You know, we see even in Taiwan, Japan. You know, basically in Taiwan, you have very, very cheap clean energy. In Indonesia, you have very good governmental support. They give you tax-free regions, and you know they let you tap into the governmental grid. So we see a lot of development in Asia. Power is cheap, land is cheap, and also the demand is coming up. Back to Marty's point, you know, for example, the Chinese just started to do overseas computational power allocation. So we're very close with Tencent, for instance. They just started budgeting and doing bidding for overseas power allocation. What does that mean is, you know, there is this misconception that the Chinese are blocked out of the immediate newest chips. It's absolutely not true. You are not allowed as a Chinese entity to own the chips, but you are absolutely legally allowed to lease them. So the only criteria is, as long as the data center does not belong to the Chinese and the GPUs do not belong to the Chinese can come over and lease for as much as they want. So we see a lot of the so-called non-Chinese entities, which could be Chinese nationals who get a new national support, you know, like a passport from Singapore and build like a data center, and then the Tencent will lease it there. Very small, yeah.
So I'm gonna talk to
Next
the,
question.
So, yeah, we have another question
Last question.
from this gentleman here, and then that's the last question, and then we're done, and
sure.
we can have conversations offline.
Okay,
It's
Go
very
ahead.
specific.
Please.
There's been talk about gold as an asset class, gentlemen online, but no mention of silver. Copper's been mentioned, platinum's been mentioned in the previous speaker. No mention of silver. What does the panel think of silver as an asset?
So let me repeat this just very quickly for anyone who's coming in online. So we've talked about gold, right? We've talked about other materials, but we haven't talked about silver. So the question is, what does the panel think about silver as an asset class?
I think that silver has significant upside relative to gold, and I think that that's you got to be in it. If you're momentum oriented, there are actual practical uses for silver which don't exist for gold in terms of being a necessary component in a lot of technologies that support AI infrastructure. I think that the idea that it can go to $200, I've heard from credible technicians and analysts, and I think that there's significant upside. Historically, there's always been a lead lag factor with gold leading first, followed by silver. And if you're of the mind that this is a multi-year cycle, particularly for the metals, yeah, I think you got to be all over silver, and I would say that you want to be all over the mining stocks. Kerr would be a good example.
Fantastic. Great job.
All right, thank you all so much. It was a pleasure.
Thank you.
Thank you.